I'm going to upset some people today with today's video. And that's okay, because my goal is not to just be the pleaser of all things business owners. Is I want to make business owners aware of what is actually in the marketplace. What are people selling them? What tax strategies are being told that this is this result? And then analyzing it to help them make the decision on, is that going to help me reach my target of the vision that I have in the future? Because there's so much noise in the marketplace right now around tax strategies, around investment vehicles, around retirement plans. How are you as a business owner supposed to know which direction to choose, which product, which strategy is best for you in your situation? And this video is going to help you answer that, but it also is going to upset some people. It's going to upset some advisors. It's going to upset some business owners who feel like I'm challenging what they've done in the past. And that is okay. If you don't like this video, you can just move on. But this video is going to be very insightful for you. A few days ago, I received this email. Today at 10 a.m. Pacific, don't miss an opportunity to learn IRS-approved strategies to reduce your tax bill and maximize your retirement savings. Keep more of what you earn. The tax reduction strategy no one told you about. High-earning business owners typically face a common problem. As income grows, so does your tax bill. While we can't completely eliminate your taxes, we can show you how to leverage your retirement plan with the goal of significantly reducing your tax bill. In this session, you're going to learn IRS-sanctioned strategies that allow you to keep more of what you make. Create a tax shelter for up to $400,000 of earned income per year. Diversify the tax treatment of your retirement income and pay yourself instead of Uncle Sam. Now, this email to a business owner would come as like, wow, this sounds really attractive. But is what I want to break down. I'm going to break down a few things here. I want to break down the industry buzzwords that are just blanketed throughout this email. Because if you start to catch on to these buzzwords, you can start to determine, are they really telling me and selling me what they want? Or are they just trying to get me to buy into something that I may or may not need? After we break down those buzzwords, we're then going to dive into what strategy is actually being pitched here. And does that strategy actually live up to what is being pitched here? Okay. I've highlighted just the buzzwords of, you're just going to hear from every accountant, lots of financial advisors, retirement planners, just buzzwords, buzzwords, buzzwords. And it makes people all sound the same. It makes you sound absolutely just like everyone else. But how are you as a business owner supposed to know the differentiation between someone that's using these buzzwords versus another person that's using these buzzwords? Hopefully today's video can help you start to discern between those things. So the first one, IRS-approved strategies. They're trying to make you believe that whatever is being pitched is safe. The IRS is giving you a checkbox. I just want to set a statement around that. The IRS doesn't approve check-off boxes of approved strategies. There are ways to use the tax code that if you do them in a XYZ manner with documentation and actual business proof of expenses and things of that nature, that you can receive tax deductions for doing specific things. But there really isn't anything that's IRS approved. It's not the IRS as an approved checklist of, you can do this and you can do that. Now, there are things that are simpler to do than other things, and those are typically what people are throwing out in these situations. But there is no checklist of IRS approved strategies. There's just the tax code, which is the law, and then there's the interpretation of that law and how you are implementing it. And it just comes down to, do you believe that you're interpreting it via case law and what has happened in the past, and are you doing it like that, or are you trying to manipulate it and get around it in different ways? But IRS approved is a way to make you feel like, okay, I can listen to this because the IRS has checked off the box. Not real. There's no checked off box. Okay, second buzzword, keep more of what you earn. Just very, very common. It's a common in financial advising. It's common in the tax industry. Keep more of what you earn. Just a buzzword. Tax reduction strategy no one told you about. They're trying to make you feel scarce, that you're stupid for not knowing this. No one's told you about this. Why? You're a business owner. You're so successful. No one's told you about it. This specific strategy, when we dive into it just a little bit, is actually quite common and quite well known. So I don't know why they use that verbiage, but it's just marketing language. It's important to know. Lots of people use it in their marketing because they want you to feel scarce about it, that it's a secret, that you're a special guest into it. Next one, significantly reduce your tax bill. Boom, buzzword, like significant. Oh, that's big. I want that. They're trying to draw you in. IRS sanctioned, again, safety. This is allowed by the IRS. Keep more of the money you make. Again, just have more money, have more abundance. This is just ripe. Those words are just absolutely ripe. And then the last one I didn't highlight here, but pay yourself instead of Uncle Sam is just another common one. It just is. This is the accounting industry, and there is no differentiation between anyone. But if you're hearing these buzzwords, it's my experience that the reason they're saying these buzzwords is because they can't articulate how they bring value to you any other way. Doesn't mean that they can't bring value to you, but it's my experience that people that use these types of buzzwords oftentimes tend to have less strategies. They actually only have one, they're a one-trick pony. They do one thing really, really well, but they don't have like a robust planning ecosystem. Not exclusive, just an observation. Let's look at what strategy is actually being talked about here. And I want to give you some hints and tools so you can start to sense what are they actually trying to pitch to me here so you can start to assess, do I attend the email? Do I not attend? Is this for me? Is this going to benefit me? Let's go through some tips of what you can say it. So I've circled the two most important things here, but I want to help you go through a process. So whenever you see something that says create a tax shelter for up to something, a dollar amount, up to a set amount of money of earned income per year, it is almost always going to be a qualified plan, a SEP, an IRA, 401k, solo 401k. And in this case, I circled that word cash balance or defined benefit plan. That's usually going to be the case when that specific type of language is utilized. It usually means they're trying to get you to put your money into a qualified plan. And I'm trying to set the stage here of we need to start to be discerning as business owners. We need to feel empowered that we can actually take this on without having to trust experts or have people in our corner. We should have people in our corner, absolutely, 100%. But we as business owners need to be able to start to quickly glance at this stuff and know, is there substance here or no substance here? But in this case, it's the cash balance plan. And this is really important because they went to the maximum. So they said, okay, at 70 years old, you can contribute a lot more to a cash balance plan than a 40-year-old. So a 40-year-old is probably going to be hundred thousands, maybe $200,000 in income that can be pushed into a cash balance plan. But a 70-year-old can contribute, like it says here, this is a true statement, they can contribute up to $400,000 a year. But the way the email is written, it kind of makes you believe that like you get access to that too, that you can contribute that much. And it's this huge tax break. That's a lot. Like they're almost making this feel like you can save up to $400,000 of taxes. And it just makes it feel like this huge, robust tax saving vehicle. And I just don't like that. So I'm just pointing that out on my end. But now I want to really test this. I want to test whether what they're telling us in this email is actually going to come to pass. And this is where people are going to get mad at me. And this is where people aren't going to like it. And we're going to dive deep in this. We're not going to just talk philosophically about it. We're going to look at the numbers. But what they're telling us is we have an IRS-approved strategy. This is in the tax code. That number is actuarially based. It's calculated based off of your age and how much income you have. Like that number is real. So that is correct. You could execute the strategy and pass an audit. But then they're telling you you can keep more of what you earn. And then they're saying that you can significantly reduce your tax bill. And they're saying that you're going to have more money. And they're saying you're going to pay yourself instead of Uncle Sam. I want to test all of that so that you can determine whether this vehicle, the cash balance, the defined benefit plan, the solo 401k, is a vehicle that should be utilized for your journey. And the cool thing about this is that every one of you is going to have a different answer. My answer is different than your answer. But is what I would like to reveal to you is what actually happens and to verify whether what they're saying in this email is fully true and not just partially true. This is a fictional scenario of a cash balance plan. We're going to make this a 40-year-old person, which you're going to see right here. We're going to project 30 years in the future. So they're going to go till they're going to retire at age 70, essentially. They already have $500,000 in their qualified plan. We're going to have an 8% net earnings rate. And at 40, you can have about $200,000 placed into a cash balance plan. The reason that this is fictional is that there's actuarial science here. So laws change and we're projecting into the future. And some of the things we're not going to do aren't going to be fully real. But the principles around the math are real. The internal rates of return, no matter how much money goes in here, are going to be real. And that's what we're going to analyze. And that's what we really need to get to the substance of to determine whether or not that email is fully true. So in this situation, if we contribute $100,000 a year, $200,000 a year, we increase it by 5% a year, we're going to have $46 million in our account, and we only contributed $10 million to get it. That creates an internal rate of return of 9.78. Now, if we stopped right here, absolutely, you would say yes to this 100% of the time. Every person on earth would say yes. Why would you not say yes to this? You create tax efficient. You saved money on taxes. We'll talk about that in just a little bit. You saved money for retirement. You got a 9.78% net return on your money. Like, that's a fabulous return consistently over time in a tax favored environment. Like, everyone says yes to this. And unfortunately, this is where this is how emails like what we saw are created. They stop right here. Let's do a little bit more investigation, go through the entire process of what actually has happened inside of cash balance and defined benefit plans. And then we can make a choice on whether we should continue or not. So the first thing we have to understand with these types of plans is that there is going to be a fee. Now, fees inside of cash balance plans and defined benefit plans and 401ks specifically are all higher than that of like an IRA or a simple. But cash balance and defined benefit plans are absolutely higher than even like a 401k because actuaries have to be involved. There's more third-party people involved. So you have to pay, people have to get paid to do a job. Even if you don't think it's necessary, there's tax returns that have to be filed. There's actuarial science that goes into all of it. There's just a lot of people that need to be paid. So what we've done here is I put a 2% management fee, which for cash balance and defined benefit plans is actually on the low end. But I wanted to give like a positive outlook of what we're looking for and what occurs when we just start having the truth being revealed all the way through, not just the gross numbers of looking at it. So we have a 2% management fee. That drops the net account balance to $32 million. Over that 30-year period, we'd have paid $6 million in management fees, but our net internal rate of return dropped to 7.72. Let's continue with the story because already, even right now, you're like, well, that's not too bad. It's $6 million in management fees. Seems a little excessive, but it's not too bad. It's not too bad. I can live with $32 million. But let's continue the story to make sure that actually can come to fruition. The problem with this is the language that email produced was tax-free, tax savings, all this tax efficiency number, IRS-approved. It starts to make you believe that you're just going to magically save taxes. But all you do with IRAs, 401ks, cash balance plan, defined benefit plans is you're deferring the tax. You're not saving the tax. So yes, you haven't paid the taxes yet, but you have to pay them in the future. So inside of this account, there's $11.8 million of taxes that need to be due. They're due in the future, not yet, but they will be due when you start pulling it out. That changes this entire conversation. We now only have a net account balance of $20 million. Our internal rate of return is now only 4.57. And we start to actually have to question, could I do better outside of this account? It starts to become a legitimate question. If you can't, this might still be a good choice, but there's still some more story to go, so it might not be. But at this current state, if you can do better than 4.57, even with paying taxes on the outside before, I don't know. Like, it seems to me like it might be a better choice for some people. I don't know. That's up to you. That's where it starts to differ. Like, some people like that idea, other people don't. But this is where it gets really, I want to really clarify that email, because that email is deceptive in my mind. It's talking about keep more of your hard-earned money, save taxes, IRS-approved. The misconception that people have around saving taxes inside of qualified plans, which is all things defined benefit, cash balance, 401k, IRA, is that they believe that when they put the money in, they've freed up cash flow, they've paid less taxes, and they magically have more money in their life. But that is not what happens. When you contribute that $200,000 into the cash balance plan, you don't have the $200,000 deduction created on your tax return. All you have is you didn't pay taxes on the $200,000. So the tax savings are actually inside of the policy, inside of the plan. They're inside the cash balance plan. You don't actually get to physically touch them. So did you save taxes? Yes. Did it benefit your cash spending, your lifestyle today? No, because the tax savings are inside. Yes, you get to grow them, and that's the account does grow a little bit better because you have more capital in there, but you have to pay the taxes in the future. So you didn't actually save anything. You delayed your taxes. It didn't have a tangible positive experience on your ability to have cash flow, which is what people that I talk to are expecting from tax strategy. They want to have more money in their pocket, and cash balance plans do not do that for your lifestyle. It's in there. You did save taxes, but it did not affect it. And I really want to make sure that point is very clear because it is often confused at a very, very high by many business owners. Let's continue the story to see what happens next. So if you remember, our net earnings rate previously was 8%. But the thing about cash balance plans and defined benefit plans specifically is that those plans tend to have life insurance and annuities either be a portion or a large portion, or sometimes even all of a cash balance or defined benefit plan, because defined benefit and cash balance plans are technically, the reason they're allowed and the way this all works is they're technically pensions. You've created a pension, and life insurance income and annuities are extraordinary at creating pensions. But the problem with life insurance and annuities is that you, as the consumer, think that you're investing, but life insurance and annuities aren't investment products, they're cash products. So you're expecting to get the 8% returns, but life insurance and annuities don't produce those results. They produce results that are more 4 to 5%. So we can't expect to get 8% on all of the money in there. So when we actually make it a 5% net earnings rate, look what happens to our net account balance. $12 million in account balance. We contributed $10 million. Our net internal rate of return is 1.4%. Would you sign up for something if you're getting a 1.4% rate of return? Maybe. You might. If you like steady and consistent income and you just want to have safety around your money in the future, that could be the right choice for you. But I know a lot of people are expecting these things that they're contributing to, cash balance plans, to actually produce a lot more than that. They're viewing it as an investment vehicle, not as a pension vehicle. And that's not what they're sold. They're sold the $46 million that we saw at the very beginning. We come back to our email. IRS-approved strategies keep more of what you earn. You didn't keep more of what you earned. You actually probably cost you more in this situation than had you done it on the outside. Now, that's not everyone. Other people might, because they might be reckless on the outside, and this might be their safety net. So that's why this is so independent, and you need to be talking and having these conversations with your team and your family office that you're creating. Have those discussions. But I've found, for me and my clients, that this honestly doesn't make a lot of sense for them. The fees are too high. The tax benefits really don't save you much in taxes. There's other things that can be done that can reduce tax bills, that can have a tangible difference on your cash flow and lifestyle today. And then, we're not significantly reducing your tax bill, so that's a lie. That's wrong. You're not significantly reducing anything. You're not really keeping more of your money. You're paying yourself instead of Uncle Sam. That's not true, because the money eventually will go to Uncle Sam. Diversified tax free retirement income, that's true. These are tax deferred accounts, so that's a true statement. But when you first read the email, is that what you were expecting? It's my experience that no, I was able to sift through that because I'm in the tax world, I'm in the financial world, I'm in the family office world. That's the world I live in. But a lot of business owners, when they see that, they're not going to be able to dissect that. They're not seeing the partial truths that are inside of that, and they're just making the choice, expecting to get the $46 million in the future. I know it's not that big for most people's situations, but bigger than a 1.4% internal rate of return is what most people are expecting. I can hear some of you thinking well, Justin, okay, that's great, but what do I do instead? How do I actually go about navigating this world? And my answer is going to be different. I'm not going to tell you to go chase different strategies. I'm not going to do that. But what I am going to invite you to do is, if you're a successful business owner and you're making above $300,000 a year, but if you're definitely making over $800,000, $700,000 a year of income, definitely $1 million, you need to take the responsibility on yourself to create and build a family office. You can't afford one yet, but the family office is how you can run a very efficient team. You'll have tax, wealth, insurance, legal, even your business inside of there that will enable you to save more in taxes and to sift through all this. But it has to be a choice on your end. You have to stop behaving like middle-class business owners and middle-class Americans and take the onus on yourself that you're taking responsibility for it, that you're going to lead this team. Because I've seen so many times, so many extraordinary business owners who are amazing at making just millions of dollars a year, run really successful companies, still getting middle-class accounting advice, middle-class investment advice, middle-class insurance advice, middle-class business like exit strategy advice. And it's because no one's communicating. They just went and found people at their local BNI or down the road, or it's their brother-in-law, and they didn't actually build a team that represents the level of wealth that they could have, the level of income that they're making. So it has to be a personal choice. So when people ask me, what do I do to solve this problem? That's the solution that I tell them. You have to build it. You have to take accountability for that on yourself. Now, we as a firm, Big Life Financial, have chosen to build that service for customers where we provide the family office setting for our business owner clients. But if you don't want to work with us, that's great. But if you don't work with us, go build it on your own, because that's the solution to avoiding emails like this and getting sucked down things that probably don't come to fruition or you're going to be severely disappointed in. I appreciate your time today. I hope this call was valuable. I hope I made people angry. I hope that it helped you as a business owner start to discern what is going on in the marketplace, what am I being sold, and does it actually come to fruition? I'm Justin Maxwell, and until next time, thanks for watching.